Hello? Hello? Anybody hear me? I can see you guys talking.
Hi, this is Cassandra from Klausner and Kaufman. I can hear you. I think they have us on mute.
Okay. Now I can't see anything, so let's say start video.
Do you see like a little plus sign on top of the, I think like on your picture?
It says 4 or 5 participants. Let me look at it. It says James added. Okay. I see the names here, but let me see, can I get back to me?
Hello,
Hello?
it's Dwayne Madron.
It's James Norwood. I'm still trying to get my video back.
There I am.
Okay, there you go. Dwayne, can you see me?
Yep, I can see you.
Okay, good.
Can you guys see me okay?
Yep, I can hear you.
All right.
Yes, sir. Is that my old actuary guy? Don't remember your name.
Patrick,
Patrick, yeah. Okay. Is Burgess around yet?
Not sure.
Oh, okay.
They probably went out to lunch.
Well, looks like you guys been getting lots of rain since I've been gone. I'm on vacation, of course. That's the reason I'm not present.
We've
Oh,
become
okay.
unmuted.
Who's the new guy?
That's James Norwood. He's on
Uh,
He's
you
one-
know him.
He's in a different seat.
Hey, Mayor, how are you doing?
I'm wonderful. How are you, Commissioner?
I'm doing fine.
Dwayne and Patrick, y'all keeping them straight?
Oh, yeah.
See, he's a familiar face for you.
right? It's nice to have familiar faces.
Oh, no doubt. Are we?
Don't forget to turn on your mic when you're talking and turn it off when you're done.
Ashley, is this your first man? This your second, right? Second.
So I need to mute when I'm not talking then.
Yes, please.
Okay, we're going to go ahead and call this meeting to order. This is our City of Palatka Police Officers Retirement Plan meeting for June 15th. Time is 1:30. We'll have our roll call at this time.
Terrell Hill,
Here.
Greg Cummings,
Excuse absence.
Ash. Only one absent.
And for the
Greg
record, we have a
Cummings.
quorum.
We have a quorum.
Moving on to item 2 of our agenda. Has everyone had an opportunity to review the minutes from our previous meeting? I'll entertain a motion at this time.
I motion to approve the minutes from the last meeting.
There's a motion on the floor. Is there a second?
Second.
All in favor, say aye.
Aye.
Opposed? Motion carries unanimously. Moving on, voting on a new member. We have with us today Mr. James Norwood Jr., a very familiar face, commissioner for 4 terms, correct?
Yes.
So 4-term city commissioner, long-term Georgia Pacific employee. And so he's put forth his application and agreed to serve on this board. And so at this time, we have to make it all official, and I'll entertain a motion.
I motion to approve James Norwood as the next pension board meeting member.
Motion on the floor. Is there a second?
Second.
Motion on the floor and a second. All in favor, say aye.
Aye.
Opposed, motion carries. Welcome aboard, Commissioner.
Thank you, sir. Look forward to working with you guys.
And so I don't know, was he supplied with the agenda for this meeting?
Yes.
Okay. So he's sworn in. Okay. So you'll be able to vote that once approved by the commission at our next meeting, and we can move forward from there. And so we'll send the recommendation up, and it should be approved on the 24th.
All right.
But please feel free to join in any discussions if you'd like today. Want to review suggestions for experience study from our prior meeting, Patrick Dolan, Foster and Foster.
Yeah, maybe Commissioner Norwood was on the board back then, I don't know, but you did an experience study in September of 2016, and they recommend experience studies about once every 5 years. And so that would be September of 2021 would be the next experience study that was due. And so I told you guys it would be about $7,500 to do the experience study, and we would look at all of your experience and then show you what that's been, and then we would recommend assumption changes and then show you what those assumption changes would do to the city funding requirements. And we talked about it a little bit last time, and you guys wanted to ponder it, I think, and then talk about it again at this meeting.
So is it necessary for us to change the assumptions? Well, I understand that you were saying that there were some trends that move towards changing the year of the assumption.
Yeah, well, like the investment return assumption, Florida retirement system dropped to 7.0%. You guys were at 8% when we did the last experience study, and you went down 0.1% each year for the 5 years. So now you're at 7.5%. And most boards have done just like you, just gradually reducing that assumption because of the low interest rate environment and the good stock market we've had. So, you know, we're recommending to our boards, you keep trying to gradually reduce that assumption, but there's not a state requirement to that effect. I mean, the state looks at your valuation reports every few years, and you know, they may come back and say the 7.5 is too high, but right now the 7.5 is about the average assumption of our plans. So I doubt you would get a letter that strong. They would probably just send you a letter saying that you should look at it. But you know, that's my feeling on the investment return assumption.
So what's the impact of not making the assumption?
What'd you say?
What's the impact of not making the change?
Well, if we don't make any changes to the assumptions and they're not really in line with reality, then every year when I come and do a valuation report, I'm going to say, oh, now the city's costs are going up. because we didn't do what our assumptions thought we were going to do. So that's the real reason why you look at these every 5 years and make changes, so that the city's putting in the proper contribution and there won't be as many surprises going forward.
They go to Commissioner Norwood. I'll come to you next, Mr. Chambers. Norwood, Commissioner Norwood, you had something?
Yeah, my question would be to Patrick. I know you talked about interest rates lowering, that's affecting the assumptions as well, but also what about retirement? And my other question along with that, is anybody taking lump sums when they do retire to affect the assumptions also?
Well, the experience study would not just look at investment return. It would
Right.
look at salary increases. It would look at when people terminate. I know in the past, I remember you guys had a lot of turnover. And so if we can change the assumption to expect more turnover, then the city's costs would actually go down, because if everybody terminates before they're vested, you'll never pay any retirement benefits and you don't need to put in any contributions. So, you know, that's the whole point of this exercise, is to look at your experience and look at all of your assumptions. Lump sums, I doubt you're able to take lump sums, maybe a partial lump sum, but most plans don't allow lump sum payments at retirement. Or maybe you meant contributions.
Yeah, contributions.
Yeah. We would definitely look at that in the experience study to see if we could change our assumption in that regard.
Mr. Chambers?
Hey, Patrick, it's Burgess, how
Yeah.
you doing?
I'm good.
So just to give the trustees a sense of the impact of lowering the assumption, let's say to 7%. Effectively, they're paying down the mortgage faster. They're putting more money into the plan sooner than later. And I made this argument with the president of your company a few weeks ago. That is, if everyone's expecting the market to go down in the near term, why would you be front end loading more money into the plan? Why wouldn't you wait? But there's already a self-correcting mechanism in your way you do the math anyway, with the smoothing. If we're not meeting the assumption that over time, the contributions would be forced to go up, but not right away. So, Brad,
I see your point in that we do evaluation every year and we look at the assets in the plan to project the funding requirements. So if we have a bad year and the investments go down, then automatically the valuation report says, okay, now you need to put in more contributions going forward. So the argument to doing it now ahead of time is that then you wouldn't have as much of a surprise when that happened. You know, the city would already be contributing that higher amount. That's the argument for doing it earlier. But you're right, the valuation automatically corrects every year and it has a mechanism to do that.
The problem is that when the city puts in incrementally more money based on, be caused by lowering the assumption, it's assumed that money is going to make 7%, let's say, prospectively.
Okay.
But we don't know what it's going to make over the next 2 years. It could make 0, could make -5, could be up 20. We don't know. It's all over the place. So that's why I'm a little, I think it's a little mysterious that everybody seems to be able to predict what's going to happen in capital markets over in the near term. I don't think anyone has any idea.
Well, they've all been right lately, so.
Well, you and your colleagues have been preaching for 3 years that the market was going down. But so would it certainly helps the cities financially in the near term if they're not compelled to put in more money. And then at some point in the future, if we're not meeting the assumption, because we've met the assumption for the last 10 years, we look at the 10-year average, capital cities under Dwayne's oversight has done better than pretty close to 8%. So, but if that starts to fade down, then the city can add more money later. I don't see why it has to be done now. And final point is the city hasn't gotten a letter from the state. That's all I wanted to say. Thank you.
Yeah, and to Burgess as well. Burgess, you talked about the smoothing. Is this? I think the smoothing is probably 5-year smoothing. I don't know, it's 5 or 7 year smoothing. It's one or the other, I believe. And I don't know what the what the pension plan has done over those years, and I don't know what's going to be dropping off and what's going, and and that kind of thing. So can you kind of walk me through it, just because I had been around for the last 5 years, and kind of walk me through what's going to actually be dropping off and where we're at as far as the 5 years for that smoothing period that you're talking about?
Sure, give me 1 second. Yeah, so when we did the 10/1/2020 valuation, the valuation report, we fresh started the smoothing. So we're going to have a 5-year smoothing, and each year we're just recognize 20% of the gains or losses for that year. So it's fresh started. So any experience that we get in this current fiscal year, we're going to recognize 20% of it this year, 20% of it next year, et cetera, for the next 5 years. That's how the smoothing is at right now.
Well, let me clarify something, if I may. 2016 drops off.
Right.
So that's where I think Commissioner Norwood was coming from. So when you do the FY21, Patrick, aren't you picking up 17 through 21 and using a 5-year average?
No. The only reason, like I said, normally that would be correct.
Okay.
But we set the market, we set the actuarial value equal to the market value on 10/1/2020. It was 11,831,000. And we said, okay, we're just going to start over with.
Okay, I got that. But let me ask you this. Let's say that their experience for FY21 is, let's just use 20%. That's a nice fat number. What does that mean for the city?
20% this year, and we were expecting 7.5. So
yeah, what would that happen? What would happen?
They would have a 12.5% gain. So that
Okay.
would be about
Good.
$1.5 million gain, let's say, more than what we were expecting to get on our investment return. And so with the new smoothing technique, we're going to recognize 20% of that 1.5 million this year. We're going to recognize 20% of that 1.5 million next year. So we're not actually using those old numbers from 2016, 17, 18, 19. Those are all behind us, and we're just smoothing going forward.
So what would the funding ratio go up to if we got 20% this year?
Well, if you're looking at the back of the report, which uses the GASB, that uses the market value. So in that case, our net pension liability last year was, let me find it, $1.6 million. And so our funded ratio was 87.9%. That's what it has in the accounting for the plan. And so if we have 1% return this year, we're going to have a gain there of about 1.5 million. So you're going to be at almost 100% funded ratio on the on the GASB side. On the funding side, you're only going to recognize 20% of that because of the smoothing. So you're going to go up some in your funded ratio, but it's not going to be as significant as the GASB.
And that,
Answer your question?
Well, I just thought I'd open it up so that members of the board could get a sense of really how this all comes together, you know,
Well, and
what all
Bert
this means.
and I have talked many times, and we both know that long term, you know, the stocks are going to give you a good return, and that long term, you know, we're going to get some earnings out of our non-equity investments. So, you know, I'm not saying that the world's coming to an end and we have to lower that assumption. I'm just saying that there's pressure, you know, from all parties, that a lot of people are projecting lower investment returns going forward. Whether you and I agree with that or not, that's what a lot of professionals are projecting. And you don't want to be too far out of line with other boards. But like I said, right now you're not. You're at 7.5. That's not a line by any means. Does that make sense? And when we do the experience study, we would show you the impact of lowering the assumption to 7.4 or 7.25 or 7% probably. But that doesn't mean that the board needs to do that. But at least you would see the impact before you made those kind of decisions.
Patrick, I know well, I guess 10 years ago, we went through the smoothing period, smoothing, and before we were not. And what would the effects be if we did not use the smoothing?
Well, you'll just have more volatility in the city's funding requirements. You know, I might come next year and say the costs are going up by 5% of payroll, and then the next year I might come and say they're going down by 5% of payroll. The asset smoothing is exactly that. It smooths it out so that the city's funding requirements are smoother. It doesn't really change anything in the long term. You're still going to have to put in whatever you need to pay everybody's benefits, but it smooths the ride by using that smoothing technique.
So basically what you just told us was if you didn't use the smoothing techniques, we don't know what it would be in order to make the fund whole each year.
Well, we know, I mean, right now you have a net pension liability of 1,625,000 as of 10/1/2020. So that's what was needed at that point to make it 100% funded. We know those numbers, but then when we do the valuation report, we don't make the city pay that in 1 year.
Right.
Spread it out. That's the purpose of the valuation report.
Right. Okay. Well, I just kind of wanted to kind of go through all of that just to kind of make, just kind of give me put my bearings back where they need to be at.
Well, and one thing is that the general employees approved the experience study at the last meeting. So I've already completed that study. And then the fire board this morning, they decided to wait another quarter because I guess the city is doing a salary study right now. And that could affect our salary increase assumptions. So, I mean, you could, delay your decision one more quarter if you wanted to. But regardless, you're still going to need to do an experience study. But we would have a little more information if we waited a little bit.
right. Agreed. The RFP is out on the streets now. So I think it makes all the sense for us to wait to see where we go from a wage standpoint before we move forward with this.
Yeah, that's fine. I just don't want you to lose sight of, I want to keep this on the agenda, I guess.
I'm pretty sure you're going to keep reminding us.
Yeah.
Mr. Mayor, I got one more question for Patrick. Is that $7,500 that it costs to do the experience study? Is that a shared cost across all three pensions, or that's just the police pension portion?
That's just the police pension portion.
Okay.
I think we charged $6,000 when we did it 5 years ago. So if you do it once every 5 years, that's about $1,500 a year.
Any other questions from the board? Okay,
Thank you for listening.
thank you. And it looks like, I guess by the lack of comments, is it our position to stay in a holding pattern until such time?
Yes, sir. I think we need to hold on it also.
So since we're not going to take any action, we won't take a motion on this at this time, and we'll just bring it back for the next meeting. So I think our next quarterly meeting will be perfect for this. Next up, Sawgrass. Thank you, Patrick.
I need to hit a button here.
Yeah,
Podium one.
lights on.
All right. On the fire meeting, I didn't hit the blue button, so I'm halfway through because I'm not going to do a lot of talking.
That's not
Lyran's
normal.
going to do the talking. So anyhow, really quickly, my name is Greg Gosh. I'm Director of Client Services for Sawgrass Asset Management. I have not worked with you all before. Welcome to the board. Have you been on for a couple of quarters now, or am I just, okay.
This is
This is what Zoom does to us. Even
Cassidy's second meeting, and this is your third or fourth.
third, okay. My apologies, but through Zoom and everyone being separated out, it's harder to develop those personal relationships, but that's what my job is to do. And we manage fixed income for you, and we've been managing fixed income for well over 12 years now. And we appreciate your business. We're up in Jacksonville Beach, Florida. Couple of just economic things going on right now that Liardon and the team are keeping their eye on. Inflation you hear about, shortages in labor, shortages in lumber. Now it says we're about to have a glut in lumber. Shortages in other commodities for building and getting this economy moving again consistently are the challenges we're running into. Despite these inflationary pressures we're also seeing interest rates, yields kind of remain low. And for how long, we'll see, but there's a lot of intervention from the federal government and the Federal Reserve that's keeping these rates low, keeping money out there and keeping things cheap. That has really made it difficult for us to, perform and give great returns in this environment because of all this intervention. However, you have a really good team, smart people that know how to navigate these waters, and Liardon's going to talk to you about how they do that, how we're positioned, how we're seeing things. And there's a lot of what ifs that are going on right now. So we're working through those. And with that, also one thing that Liardon's going to talk about as well is we moved over to the CIT from the separate account, which is going to make it easier to actually move in and out of our fixed income fund for you over time. It also lowered your fee. Because of when we did the transition, there were some issues with the market, a lot of volatility, the most volatile quarter we've seen since 1981, to be exact. We have tried to true that up for you from Sawgrass. So Liardon's going to talk about that as well. I know that was something in the minutes in the fire meeting that was also asked about. So with that, are there any questions about Sawgrass, the firm, or anything going on with us? Okay, Liardon.
Thank you.
Good afternoon, everybody.
Good afternoon.
My name is Liardon Gila. I'm the fixed income portfolio manager at Sawgrass. First of all, I'd like to thank you for the business. We appreciate the opportunity to manage your fixed income portfolio. It's an honor for us. Thank you. Before I begin with the presentation, As Greg mentioned, I wanted to clarify a few points with regards to the CIT, the fund that is managed by Sawgrass. As you know, last year you voted to transition your separately managed fixed income portfolio to the Sawgrass, to the newly created Sawgrass CIT fund. And the idea there is that you would have the same exact strategy that we've been managing for you in the past, have that same strategy manage it in the future, but you would switch the vehicle from a separately managed vehicle into a fund vehicle. And the main benefit from your standpoint was really the fee reduction. You would essentially see a higher net of fee performance going forward because of your savings and fee. So part of that process, that transition process, required your portfolio to basically sit on cash for one full day. And that was the mandate that came from the custodian of that fund. And we didn't really have a choice as a manager. If it was up to us, obviously, ideally, we wouldn't have never kept you out of the market. But that one day that forced your portfolio to be out of the market, you were sitting in cash. It just so happened that one day was a big rally day and you didn't really benefit the performance for that one day. And after consulting with Burgess, Sawgrass made the decision to make you whole for that one day. So that translates into the amount of $14,500 that the Sawgrass sent you the check for that one day return. And the idea there is to make you whole for that one day. So the full monthly return would be the same as our strategy as the rest of the accounts. So from your standpoint, you would be indifferent. Now, if it would have gone the other way, if the market would have sold off and you were in cash, you would have still benefited because you wouldn't have gotten that one day negative return. But from what actually happened, we wanted to make sure that you were whole and you were indifferent to whether you go with a CIT or a separately managed account. So that's pretty much it. As we speak, the transition is complete. So we've basically, your portfolio is fully invested into the Sawgrass CIT fund. Today we're here to talk about the first quarter return. That's still the separately managed account portion. But going forward, starting with the second quarter, what you will see in the statement is you will see the Sawgrass CIT fund, and then you'll see your unit share. But keep in mind that it's the same exact strategy. There's no change. The only difference is basically a saving and fee, a lower fee proposal that will benefit you in the future in terms of the net of fee. Any questions with regards to the CIT and the transition related questions? Okay. All right, well, let's talk about the performance for the first quarter. If you turn with me on page 12, I'd like to start with just the accounting side. At the beginning of this year, we started with a market value of 2.71 million. You had a cash inflow of over 726,000, $23,510 of negative loss for the full year. And that brings you to a 3.419 market value as of 3/31. Looking at the performance on page 13, we had the worst quarterly performance for the bond market since 1981. It was a very volatile quarter for us. And in addition to that, we also underperformed for the quarter. And I'll get to the attribution in a little bit. But in terms of the drivers of the market for the quarter, it was really the positive news that we got on the vaccine front, the speculation that the economy will open up much faster than anybody was anticipating. The labor market is continuing to improve. And then most importantly, the inflationary fears were the real drivers of this huge spike in rates that we saw in the first quarter, 100 basis points in just 90 days. That usually doesn't happen in the bond market. And we've seen, you see the commodity markets. We've seen lumber, copper, oil, any basic commodity that they're all up double digits just in the last few months. We've seen a lot of stories about the big interruptions in the supply chains, all these supply chain bottlenecks. A lot of anecdotes in with this, for example, the chip shortage affecting the auto market, and so many stories like that. And in addition to that, you've got the huge pent-up demand on those industries that were hit the most last year, such as travel and leisure. So that's really affecting the overall inflation composite. So take all that into consideration, and that's what's really drove the increase in rates. If you look at your return on page 13, yes, we underperformed for the quarter, but if you look at the 3-year, 5-year, those are still very solid numbers. So this was just a one quarter hiccup for us, if you will. But longer term numbers still look very, very solid and still decent positive return. And you got to keep in mind that, for example, last year and the year before, you were coming off of some really good, strong absolute numbers. Last year, we generated an over 9% return for you. The year before that, it was another 9% year. So we were expecting a slight increase in rates. We didn't anticipate this type of speed of increase in rates. We did position the portfolio more conservative relative to the index at the beginning of the year, meaning we were short duration. What hurt us the most was really the overweight in mortgage-backed securities. At the time, we were thinking the Fed will take the time with the Fed rate hikes. The economy still looked weak. There was a lot of uncertainty. And we were thinking that we're going to be in this environment, these low rate environments, muted volatility for a while. And at the time, relative to everything else, it made sense to own mortgages for the carry component. Well, the last thing you want if you're long mortgages is to have a spike in volatility, huge increase in rates, because what that happens is it decreases the refinancing optionality, and that makes that security longer in maturity. So you get a longer maturity at the exact wrong timing, meaning when the rates go higher. So that's what really hurt us in terms of the relative return. If you look at the changes that we've made for the quarter, I'll jump all the way to page 26. You know, with the mortgages underperforming, we didn't sit still. We took some action. We reduced that sector. So we went from an overweight position to an underweight position. And you've noticed in the bottom half of that chart, we've increased the allocation to treasuries to an overweight now. Because with the recent sell-off in rates, that relative analysis changes the equation. So now treasuries actually are much more attractive from a carries perspective, and you get the certainty from a duration standpoint. So those are the two features that we like relative to mortgages. And you will see with the corporate side, it's basically unchanged for the quarter. And if you flip with me on the next page, on page 27, looking at the current position, your current portfolio is, similar yielding to the index. From an allocation standpoint, you would see that we are underweight, as I mentioned, mortgages and a little bit on corporates. And with the treasuries, you see that big jump in treasuries. That's a little bit new in the fixed income land. Not a lot of bond managers are overweight treasuries, but we made that decision because if you look at the current market, basically the Fed has this giant put option, not only in the bond market, but in every financial asset class. Stocks are expensive, credit markets are expensive, commodity, everything is being affected by this huge liquidity program that the Fed has already put in place. As you know, they're buying $120 billion worth of securities, 80 billion of treasuries, 40 billion of mortgages every month out there in an open market. And that's really affecting not only rates, but it's affecting liquidity, risk premiums. Everything is super inflated. So with that in mind, if I look at the credit market, they're basically trading at near record valuations. And if you adjust it for the fact that a lot of these companies have termed out their maturities, meaning the average maturity now is much longer, so the sensitivity is higher. Quality has also been downgraded. A lot of these CFOs, they're doing a lot of these recapitalization programs where they're issuing debt and they're buying back shares to inflate their EPS because they don't have earnings growth, real earnings growth, but they want to do a lot of these financial engineering because the cost of debt is so cheap. So, but from an investor standpoint, that's not a good mix, right? You've got a longer maturity than you've had in the past. That's a lot more sensitive. Spreads, meaning the difference between the corporate yield and the treasury yield it's at all-time record low. And the fact you've got a much lower quality now because the company is a lot more levered. That's not a good recipe. So we feel that credit market is very rich, and we've taken the position to be underweight, have a lot of dry powder, meaning have a lot of safety, liquidity with the treasuries, and just wait for a better entry point if we get it down the road. But in terms of the expected return on page 31, the reason why we're very comfortable with the treasuries is because we're not giving up much in terms of carry. And you can see that on this page where this is what we call the sensitivity analysis. We put together this range of different scenarios to give you some sort of an expected total return for the next 12 months. And if you look at, for example, under scenario number 3, column number 3, that is the no change scenario. So that is if rates don't change and spread markets doesn't change. Under that scenario, you would still outperform the benchmark by about 30 basis points and generate a 2% total return. Now, if you look at the most consensus forecast, that's basically looking at what the top world economists are expecting on number 12. even under that scenario, we would expect to outperform the benchmark by 50 basis points and still generate a low positive single digits. So that's how we position your portfolio. Have some dry powder, be mindful of relative value, and wait for better attractive levels in terms of the credit exposure. With that, I'll conclude my brief presentation. I'll take any questions.
Hey, Laird,
Yes.
It wasn't brief, but can you update the board on this quarter? And as you see a negative number, which you really see, can you update ballpark how this quarter has played out versus Q1?
Yeah, so this quarter has been the complete opposite. Greg, you mentioned the fact that the rates have kind of stalled in terms of they spiked to 175, now they're down to 150 for the 10-year. In terms of the quarter to date, we're looking at positive numbers. So that -4% is actually down to like -2%. So you've made some ground from that big negative number. We are in the camp of what the Fed is expecting. Everybody's is being spooked by these inflationary fears. Well, if you take a look at a lot of these commodities, for example, take the example of lumber. The reason why we had this huge spike in lumber is because a lot of the labor force was off the network, right? So once that labor force comes back to the network, you will see that the prices would tend to normalize. And that is exactly what has happened. If you look at the number now, it's basically down 40% from the recent peaks. And that will trickle down to the housing markets, and a lot of other industries will be affected by that. So we believe what the Fed is communicating, they're saying that the inflation will be transitory, and we're expecting a transitory inflation. We're expecting slightly higher rates, but not a runaway inflation, no runaway rates like we've had in the 70s. So that is our own forecast, and we're sticking to that.
Any other questions? Seeing none, I entertain a motion as to the report.
I motion we
Yeah.
accept the report as presented.
Mr. Mayor.
Motion.
There's a motion on the floor in a second. Commissioner Norwood, do you have any discussion?
Yeah, I've got one thing for discussion, if I could. I was not able to open up the report due to the password that I do not have. What does this portfolio actually looks like? What's the makeup of the portfolio?
It's a high quality fixed income core portfolio. The mandated benchmark for the strategy is the Bloomberg Barclays Aggregate Index, which is the most widely held, plain vanilla index. So it is a plain vanilla bond portfolio, high quality bonds being bonds. Okay,
what's the makeup of it versus stock versus liquidity and all?
So in terms of liquidity, I would rate it as the highest, the most liquid portfolio you can put together. It's got a mix of high quality government securities, U.S. Treasuries predominantly. We're talking 60% exposure right now in Treasuries. You got agencies, high grade corporate bonds, and mortgage-backed securities.
Do you have a pie chart? Do you have a pie chart showing the makeup of the portfolio?
Sure. Yes. So as I mentioned on page 27. I know you can't open the PDF, but if you look at the sector allocation, it's got a breakdown of 60% treasuries, 2% agency bonds, 23% corporate investment grade bonds. And by the way, those are all A or better primarily because of your IPS mandates an A or better investment grade exposure, and then 15% mortgage-backed securities. And if I look at the characteristics summary composition, it's got a yield maturity of 1.43 relative to the index of, call it 1.5, a slightly shorter duration, and the average composite rating is AA+ versus a AA on the index. So it's higher quality than the index, and that is by design, because of what I just talked about. Given where risk assets are trading, we felt compelled to move up in quality, given where everything is trading.
Okay, looking at your portfolio as I'm looking at it right now, do you expect the Treasury, based on the lowering the interest rates or raising interest rates, do you expecting the bonds to actually grow in interest anytime soon? Because right now your bonds are quite higher. You got quite more Treasury bonds than the aggregate does.
Yes, and the reason for that is more of a defensive position because of where risk assets are trading. They're trading at record levels. You're not getting paid for that, the marginal income that you're getting is not in that same, the risk that you're taking is exponentially higher relative to that marginal income. So we've made the decision to give that little income and wait for better entry, meaning we're waiting for some sort of sell-off in investment grade bonds for us to consider, the levels and have a lot of dry powder and get back to the credit market.
Okay,
So go
I
ahead.
guess my other question is concerning that it's going to be the Burgess calls on his recommendations, I guess. And I guess I just need to hear what Burgess' recommendations are going to be.
Sure. I mean, our overall position is everything is rich, and in the bond, especially in the bond portfolio, we've always been a big advocate of maintaining a high quality approach with regards to the bond portfolio. And a perfect example was what happened last year. We were one of the few managers. As a matter of fact, we were less than 10% of the all bond managers out there in the country that were able to outperform the index, not only in the first quarter of last year, that basically everything, what happened in the first quarter, but also in the second quarter, we outperformed the index. So we generated 2 strong quarters for you and maintained the liquidity and the quality and that true diversification that really helped you in the most severe sell-offs that we've seen in a long time. So that is our approach. We're not a one-trick pony, but we're very relative value mind conscious. And we take the bets, we take the risks when we're getting paid to take the risks.
Thank you, Mr. Mayor.
Thank you.
Any other question? Seeing no more discussion. There's a motion on the floor. All in favor, say aye.
Aye.
Opposed, motion carries unanimously. Thank you.
Thanks.
Next up, Dwayne Madden.
Good afternoon.
How are you, sir?
I think Jill's going to put up my presentation. Looks like that. There we go. You can scroll down to the policy page, please, Jill. First off, before we get started looking at the asset allocation, I want to say that the first quarter, as many of you know, was a good economy. Optimism abound. There was ample liquidity in the market, which means there was plenty of cash on balance sheets, cash on the sidelines, pent-up demand, stimulus from the Fed, loans to businesses that did not have to be paid back. And in addition to that, the US dollar firmed a little bit, and there was job growth. And then around January, February, there was a rollout of the vaccine, which gave people a lot more confidence. So having said that, the first quarter equity returns were approximately 6% for the S&P 500. International lagged a little bit at 4%. But surprisingly, value stocks did better than growth stocks. And we haven't seen that in a while. And that's because in the early stages of an economic recovery, cyclical companies tend to do well, and those tend to be value-oriented companies like financials and consumer stocks and oil stocks and commodities and metals. And in addition, small stocks did very well. Small stocks were up 12.9%. And historically, small companies do well when risk is on, when things are growing, when things are good. The small companies tend to grow because they're growing faster and investors flock to that growth. So the highlights of that first quarter were mid-cap and small-cap stocks. In addition, just any equity type investment was in demand because risk was on, money was leaving bonds or it was leaving the sidelines and going into riskier assets. And all of this pushed the prices up of everything. Everything's a little bit expensive. Like Sawgrass was saying, everything is rich. So looking at the policy, the cash, if you scroll up a little bit, Jill, to the top, cash today is about neutral. I've had to trim equities a couple times. So I've got a little dry powder there in case there's a pullback, which there might be in the next couple of days. But I'm overweight US equities at the expense of being underweight international and underweight REITs and underweight infrastructure and underweight convertible bonds. And so convertible bonds, I'm a little bit underweight on because interest rates affect convertible bonds in a negative way, but also because I prefer companies that grow, like Apple, Amazon, Target, Walmart, JP Morgan, Berkshire Hathaway, Johnson & Johnson. These are more predictable and more stable and more consistent than bonds that are have a hybrid equity-like behavior. In addition, real estate is expensive, as is stocks. However, because the supply of real estate, commercial real estate, is relatively low as compared to demand, there may still be upside in real estate. But at a yield of 3%, that's the lowest yield in real estate since 2013. The price to funds from operations is 27, higher than the historical norm of 18 to 21. And also, real estate is a non-homogeneous asset class. You got hotels, malls, and offices, which at this point are a little bit uncertain. So I would rather take the certainty of Target, JP Morgan, and Apple versus hotels, malls, and offices. So I do think over time, real estate will come back up to its policy target. But for now, I prefer the large cap US stocks. Any questions on that page? If not, we can scroll down to the performance. Okay, so here's the good news. As of March 31st, year to date, which would be, the latest quarter, which is the same as year to date, is 5.62% for the equity portion of the plan, 6.4 from the stock side, 0.24 on the bonds that we manage. Now, these bonds are high yield bonds and convertible bonds, which the policy sees as equities. So there is a little bit of equity-like bonds on the Capital City Bank side. Real estate 8.69. So in hindsight, maybe I should have been overweighted real estate for the quarter, but I wasn't. But over the past 1, 3, and 5 years, large cap equities did better than real estate. So at least over the long term, it was a good move to be overweight large US equities. Any questions? And then the last year, 57.92, stocks were up 64.23. This is quite an unusual period of time. And fiscal year to date, through the end of April, the plan is on the equity side is up 26%. That's not including the Sawgrass side, and that's pretty good. So between now and September, I think things are looking good for maybe a 15, 16% return if things don't fall apart between now and then. If there's not any questions on the returns, we can scroll down to the snapshot of the account. Asset allocation, there's April, by the way, 9% year to date as of April. And then asset allocation, we've got, in a traditional sense, scroll down a little bit more, Jill. In a traditional sense, we're 59% equity, 31% fixed income. However, the fixed income, the equity side or the fixed income side includes high yield bonds and convertible bonds, which otherwise would be classified as equity for the purpose of the policy. But in a traditional sense, you're 59% in equity, which is a moderate growth portfolio. And this does not include the infrastructure, which probably is another 3%. So still a moderate growth portfolio, not aggressive, but not balanced. I think that's worked well for the plan over the years. And if, Jill, if you want to scroll down, the rest are the funds that are held in the account. There's the Sawgrass CIT, the convertible bonds from Spider Barclays, Vanguard High Yield Corporate Bond Fund. Then there's a couple Fidelity funds. Then there's a Vanguard S&P 500 Index, American Funds, which has been a successful international equity manager, and then the Developed Markets Index Fund. So, and then the real estate fund below that. And so that concludes my comments. Any questions?
Any questions from the board? I'll entertain a motion.
A motion to accept the Capital City report is presented.
Second.
Second that motion.
There's a motion on the floor in a second. Is there any further discussion? Seeing none, all in favor, say aye.
Aye.
Opposed, motion carries unanimously. Thank you, Mr. Madrid. Next up, BCA Chambers.
Good afternoon. Commissioner Norwood, are you able to see the screen okay from your end?
Yes, sir.
All right. So if I'd like to ask you all to go to page 7, please. Joe?
Where does that 14?
That's 14. Let's go to page 7. She's good. She's just warming up here. There you go. I don't know if you can all see that. Just as a comment, I know this is all public information, but the actuaries are making the same case to go to 7 with all the plans, everybody. Whether you made the 8% per year, that's net of expenses annualized for 10 years, or you made 6% or 11%. They're still hammering everybody to go to 7%. The state of Florida retirement system is at 7 now. They went from 7.2 in the last 4 months or so. They moved down to 7. But I should add that the Florida retirement system, which is a behemoth program, what is it, 150 billion, Dwayne? Something like
Close to that if you include the other trust accounts that are there.
Their portfolio looks nothing like this. In fact, it looks nothing like most of these plans in Florida. FRS does a lot of things we can't do. They'll buy farmland in California from an insurance company. They'll buy a development that went bust and then sell it in a couple of years to a real estate developer. They'll buy a warehouse in South Florida that caters to the cruise business. All the liquor sales that are ordered at this warehouse, these robots go out and load up these pallets and load them on trucks and take them out to the port. Real high tech stuff. But we don't invest in things like that. And so FRS is being pressured by their consultants to go down to 6.5% and maybe even 6 at some point. So that's the sort of the background noise. But frankly, you're doing fine. You're making a nice return here. Your expenses are about half of what your peer group is paying. And that's just, I think you get the point. I don't see any rush in going down. It's not going to hurt you. If it's delayed, it's not going to hurt the plan, and I don't believe it's going to hurt your likelihood to get your pension. Any questions about that? Let's go to page 15. This is important, and this is a reflection really on Dwayne. He's done a fine job. These are different time periods that measure your performance to your peer group. And so if you look at the 1-year number, for example, you'll see in parentheses next to 39.3, 19. That means 19th, top 19th. So 81% of your peers are below the blue dot on that column, those 4 colors. And that's where your peers, the vast majority of them, didn't do as well as you did. You look at the 3-year period, you're at the top again in the top 16th percentile. For the 5-year, the top 18th percentile. Now this was achieved because a couple things. One, Dwayne, even though there's a 65% target allocation to equities, he's tended to keep it up towards 70%, which is okay. He dialed in more risk, he got rewarded for it. Okay. Secondly, it's been more of a US centric equity portfolio. He has had an underweight to foreign stocks. And number three, we don't have any foreign bonds. That's been helpful. And then finally, your expense ratio is at 30 basis points, which I mentioned earlier, is about 0.3% or 1/3% below your peers. Okay, so asset allocation has been the key driver and management of costs. Any questions? Commissioner Norwood asked about bonds, and while he's still awake there, I know I see him yawning now. He's going to go to sleep on me.
No, I'm not asleep yet, but
Okay.
and I was just looking at Sawgrass. Looks like they're just awfully heavy in bonds.
Well, that's true, and it's because that's their mandate. That's all they were hired to run the bond portion.
Okay,
That's the reason.
makes
Okay.
sense.
Okay. Let's go to page, I'll skip the Bitcoin piece on page 1. You can read that in your spare time. You made a lot of money in Bitcoin. Don't get involved in Bitcoin. Bitcoin will become illegal at some point. I would say probably over 200 million at least, it's unknown, has been extorted by nefarious characters using Bitcoin and the wallet as a means of payment. And it looks like in this Colonial Pipeline heist that you all followed a few weeks ago, the US authorities were able to intercept a portion of that extortion payment through means that are way above my pay grade. But it looks like the US intelligence people are trying to get their hands around this, and I certainly hope they do soon. The Chinese government has made Bitcoin illegal to own and trade. So is India. Those are the two largest countries in population in the world. Japan has done the same, and the US and Europe haven't done anything yet. But I would imagine that probably in the next couple of years, you're going to see a major shift in policy to shut down Bitcoin. And the other players, there are probably 25 others that are doing the same thing. Banking, financial transactions need to go through an intermediary, a bank, a clearinghouse, where there's a trail where the money can be identified and tracked, and not through encryption. That's just our view and a view of many people. But if you're younger than 25, you probably are all in on Bitcoin. On page 4 is the summary. And as I mentioned, you have a 65-35 model. Your peers around the state fall within, I would say, a 65 to 72% target for equities. You're a little bit shy of that, but as I mentioned to you, Dwayne's been able to achieve these nice returns in spite of this more conservative posturing with the overweight, about 5% overweight generally to equities. Results were a little bit behind the model for the quarter, and that simply has to do with the allocations. We did have an underweight to the REITs, as Dwayne mentioned. That had an impact. For the 1 year period, 39.1 was the net return ahead of the model, top ranking. The convertible bonds are an amazing story here, 80% return for the year. And does anybody want to step up and venture to guess why it did so well? I'll give you a hint. A company that is familiar to those in Florida on the Space Coast. That's one hint. Second hint is this company builds electric cars.
You drop one.
So Tesla became the largest issuance of convertible bonds, and they represented, I believe at one point, about 15% of the index. And Tesla stock went up how much last year? 300%? 600%. So because the convertible bonds have the equity optionality built into them, the Tesla convertible, do you find this interesting? The bonds moved up like the stock. And so that was a huge impact here. There was some other, there was a cruise line, I think Carnival was one of them that did an issuance during the COVID and no one was interested in it. It was deeply discounted. And then when the vaccines became public and available in November, that stock took off and it drove up the value of the index. So it's a very interesting phenomenon. We talked about the 10-year already. And I think if you looked at the last 20 years of this plan, results have been right around 8% per year for 20 years. Cohen and Steers, infrastructure, fairly new here. And I don't know if you have any more questions, but if you go to page 11, you can see the distribution of these programs. This is similar to what Dwayne showed you, but it's organized a little bit differently. But you can see that Cohen and Steers infrastructure, what that means is airports, railroads, cell towers, toll roads. And in this post, I'll call it post-COVID. Are we post-COVID now?
No,
Not quite?
not quite.
Not quite. But I think this is going to be, and when we are post-COVID, these things come down, right, Mayor?
No,
This is a post-COVID play. It should perform nicely as people start going on cruises again and start spending money on driving more in Europe and flying more. Air traffic is up 80% now. Things are starting to turn, and that was that's our feeling on that. And that's all I have for today. And appreciate the business and open it up to questions.
any questions for BCA?
Just in reference to, I guess, the reports that we got from Sawgrass and SunTrust, do you have any recommendations at all? And and I know that we were under on REITs, and I know we had made a special effort probably 6-7 years ago to really pay attention to REITs and that kind of thing as well. When we were on the city's pension board, do you have any recommendations at all for us?
Well, I'm looking at page 8. Let's look at that real quick. I mean, it's fine. Dwayne has a 13% overweight, 13.1% overweight on page 8 to domestic equity. I think that's perfectly fine. If you're going to do that, you have to underweight the other equity categories, and you can see where he's done that. The convertibles have already had a big run, so there's no reason to be being underweighted there is perfectly fine. I would agree with him that the REITs are extraordinarily high, but I would also argue that they will probably go higher because we've had $7 trillion in capital from both the U.S., from Congress, the Treasury, and from the Federal Reserve injected into this economy. And that is unprecedented. And that is going to affect real estate. It's going to drive it up further. So that would be the one compelling reason that the NOIs are going to continue to go up with commercial. Also, the replacement costs keep getting higher and higher. So that means that not only does that drive up real estate commercial valuations, but it's a great inflation hedge. The PPI numbers came out today, 6.5%. We're clearly in the midst of a wave of inflation, and the REITs are a great hedge. The underweight to fixed income is appropriate. That's all I have, Commissioner.
Okay.
Any other questions?
Thank you.
If not, I'll entertain a motion.
I motion to accept the Burgess report as presented.
Second that motion.
There's a motion on the floor in a second. All in favor, say aye.
Aye.
Opposed, motion carries unanimously. Thank you again, Mr. Chambers. Next up, KKJL.
Good afternoon. Can you all hear me?
Good afternoon, Ms. Harvey.
Thank you.
Hey, gentlemen.
I'm going to make it short and sweet. I really don't have anything official on the attorney's report today, but I will like to remind everybody that your Form 1 financial disclosure form is due July 1st. You may remember that there is a grace period to September 1st. And at that point, if your form has not been filed with the supervisor of elections office in the county in which you reside, you will start incurring a $25 a day fee, which is up to $1,500, which is payable from the trustee personally rather than the pension fund.
Okay. Well, we appreciate it. And you can get your Form 1s out front. And then you just, and you have them.
Sunny
You
has
can get
them.
them from Ms. Krantz out front, Sonny. And you just make a copy of it, keep a copy for your records and take it to the supervisor of elections office.
I think you can also fill out the form and email it in or mail it via certified mail, whichever is works for you all.
Yeah, we normally just take ours to the supervisor of elections office.
Is it
And then
close by?
Yeah, everything's close by in Palatka.
Since I won't be affirmed until the next city commissioners meeting, and that's going to be probably, as the mayor said, probably July 24th. When do I need to get my form in?
Well, you're a commissioner?
He's former commissioner.
Former commissioner, okay. So under the statute, it says that newly appointed trustees must file their Form 1 within 30 days of appointment.
Okay.
So that's, you're very welcome. Are there any questions about that or anything else?
No, looks like no questions, and we appreciate you appearing today.
Thank you very much.
Thank you for your patience.
Absolutely.
Next up, budget for fiscal year 2022.
I was going to mention that the rebate that Sawgrass gave us this year was $14,400, which is basically their investment fee for the year. They gave it back to us last month. So what you're going to see in the investment fees for 2020 are going to be a lot less than we anticipated. But this is the new, they've gone up. My estimates have gone up to, for them, $15,000, but these are the new estimates for the year. You'll see that there's schooling for 3 trustees to 1 conference. The state has said that they are going to be holding a conference in Orlando. They just have not published any details of when it's going to be. Usually it's in November, December. As soon as I find it on their website and they publish it, I'll let you know.
Okay.
Jill, if I may, and I hate to interrupt, but I did after the last meeting, I called the state to see when their next conference was. And they said they're not holding one this year.
Okay.
So if I find anything else out, I will certainly let you all know. You may find out before me, but that's what I found out in between meetings.
Well, definitely. We appreciate the update.
Thank you.
That was helpful. And
That might come off the budget.
so let's just hold it. I think worst case scenario, we'll still have it there. You've seen the recommended budget for our fiscal year 2022. Are there, at this time out, are there any questions or concerns as it relates to the budget that's presented before us today? If not, I'll entertain a motion to accept.
Motion to accept the budget is presented.
there a second?
Second.
It's a motion on the floor and a second. Any further discussion? Seeing none, all in favor say aye. Aye. Opposed, motion carries unanimously. Next up is our expenditures. Turn sideways so we can. We better right click it. Rotate. Yeah, it will. Yes. There you go. Okay. Ms. Kaiser, anything you want to highlight?
I can't hear, Ms. Muir.
The turnovers have been fairly normal. There's been 4 contribution refunds done since the start of the year in the last 6 months.
Okay. Yeah, we're seeing frequent turnover at the police department based upon various factors. I think that one particularly is that the salaries are significantly higher in our surrounding areas, and some of our young officers who are from the St. Johns County area, they're moving on to different locations, and so those are things that we're going to be addressing on the 24th. And so we'll have a better picture when we come back for the next meeting as to what's the direction. We need a motion to accept the expenditures as presented.
A motion to accept the expenditures as presented.
Second.
There's a motion on the floor in a second. All in favor, say aye.
Aye.
Opposed, motion carries unanimously. We'll now open the floor for public comments. Public comments are limited to 3 minutes. If there's anyone in the YouTube chat, please leave your comments there. There are no comments in the YouTube chat. We'll close public comment and we'll move on to our other business. Is there any other business before the board at this time? When's our next scheduled meeting?
The 14th of September, September 14th.
So our next scheduled meeting, September 14th. If there's nothing else before the board at this time, I'll entertain a motion to adjourn.
I motion to adjourn the meeting.
Stand adjourned. Thank you very much to everyone for participating, and we'll see you back in September.
Right.
Stay.